You're looking at your phone right now, you see silver at $63.94 per ounce, and you think, okay, it's up a little bit. Wrong. That number tells you nothing about what's actually happening in the physical silver market. That number is what traders are paying for paper contracts in New York. It's what speculators are betting on screens. But it's not what you will pay to get actual silver in your hands. Try it right now. Go to any major bullion dealer, APMEX, JM Bullion, SD Bullion. Try to buy a silver eagle at $63.94. Try to buy a 100-ounce bar at spot price. You can't. The premiums have exploded. Silver eagles that should theoretically cost $64 are selling for $75 to $80, if you can even find them in stock. That's a 19% to 27% premium over the official price. 1-ounce rounds from private mints, you're looking at $70 to $72 minimum. Even 100-ounce bars, which traditionally carry the lowest premiums, are going for $65 to $67 per ounce. And here's the kicker. Those are the prices for back-ordered inventory. Many products show 4 to 6 week delivery times. Some dealers have stopped taking orders entirely on certain products because they literally cannot source the metal. So the question becomes, if the price on your screen says $64, but you can't actually buy it for less than $70, what is the real price? By the end of this video, you're going to understand exactly what's happening, why the entire pricing mechanism is broken, and why this situation is about to get much, much worse. Let me show you what's really going on. Silver just had the most explosive year in modern history. As of December 15th, 2025, silver has risen 19% since January 1st. Think about that. In a single calendar year, silver has more than doubled. It started 2025 at $28.97 per ounce. It peaked at $64, $30 on December 11th, a fresh all-time nominal high. Even after some profit taking, it's still hovering around $63 to $64. This isn't a normal market move. This is a structural break. Gold has had an incredible year too, up significantly, but silver has absolutely crushed it. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has collapsed to around 67.1. That's down dramatically from where it's been historically. When silver starts outperforming gold like this, it's telling you something fundamental is changing in the metals markets. It's telling you that industrial demand is overwhelming investment demand. It's telling you that the physical market is decoupling from the paper market. Here's what the mainstream financial media isn't telling you. The spot price you see quoted, that $63.94 figure, is almost entirely determined by futures contracts trading on the COMEX exchange in New York. COMEX is predominantly a paper market. It's a casino where participants bet on the price of silver without ever touching physical metal. According to industry estimates, for every ounce of physical silver backing these contracts, there are anywhere from 100 to 500 paper claims on that same ounce. Think about that ratio for a second. If you went to a parking garage and they gave you a ticket for a parking spot, but then gave 100 other people tickets for that exact same spot, would you call that a functional system, or would you call it fraud? The COMEX system works as long as everyone agrees to settle in cash. As long as the vast majority of contracts expire without anyone demanding physical delivery, the paper price can float in its own universe, disconnected from physical reality. But something has changed in 2025. The physical market is screaming a completely different story than the paper price. When you try to buy actual silver, metal you can hold in your hand, you're not paying spot price anymore, you're paying massive premiums. Here's what the premium structure looked like as of mid-December 2025. American Silver Eagles, $75 to $80 per ounce. That's $11 to $16 premium over spot. For a government-minted coin that typically carries a $3 to $5 premium in normal markets, this is absolutely unprecedented. Generic 1-ounce rounds from private mints, $70 to $72 per ounce. These are the most basic form of investment silver, and they're trading $6 to $8 over spot. 10-ounce bars, $68 to $70 per ounce. Even in larger quantities, you're paying $4 to $6 over spot. 100-ounce bars, $65 to $67 per ounce. These are the products that should have the tightest spreads because they're purchased by institutions and serious investors buying in size. Even here, premiums are running $1 to $3 over spot. Now it's normal for there to be some premium on physical silver. Dealers need to cover their costs: refining, manufacturing, shipping, storage, insurance, overhead, profit margins. In a healthy market, those premiums run about 2% to 8% over spot for most products. But we're not talking about 2% to 8% anymore. We're talking about 10% to 27% premiums. That's not normal, that's a market dislocation. And it gets worse. Those prices I just quoted, Many of those products are showing out of stock or backorder status on dealer websites. Delivery times have stretched from 1 to 2 weeks to 4 to 6 weeks on many items. Some dealers have completely stopped taking orders on specific products because they cannot obtain inventory. When e-commerce sites can't fulfill orders for a commodity, when major dealers are turning away business, when delivery times stretch from days to months, that's not a pricing issue, that's a supply crisis. Let me tell you about what's happening in India, because India is one of the canaries in the coal mine for precious metals. India is one of the world's largest consumers of silver, particularly for industrial use, jewelry, and religious purposes. Indian dealers operate in a market where physical delivery is non-negotiable. You can't settle a contract in rupees when someone wants actual silver for their business or their temple. Reports from the ground in India indicate near zero availability of silver. Dealers who normally handle tons of physical silver per week are scrambling to find even small quantities. Import flows have slowed to a trickle. This isn't a localized issue. This is a global supply chain breakdown. And it's happening while the paper price is supposedly stable at $64. So let's talk about why this is happening. What has changed to cause this massive divergence between paper and physical? The answer is a perfect storm of factors that have all converged in 2025. The first major factor is the supply deficit. According to the Silver Institute, the global silver market has been in deficit for 5 consecutive years. In 2025 alone, the estimated deficit is 95 million ounces. Over the period from 2021 to 2025, the cumulative deficit is approaching 820 million ounces. So let me put that in perspective. Total annual silver mine production globally is around 1.05 billion ounces. Annual demand is running at approximately 2 billion ounces. That's a structural imbalance of roughly 150 million ounces per year that has to come from somewhere. Where does it come from? Existing stockpiles, recycled silver, investment holdings being liquidated, but those sources are finite, and they're drying up. Here's the problem with silver supply. Unlike gold, which is primarily mined as a primary product, most silver is produced as a byproduct of other mining operations. About 70% of silver comes from lead, zinc, copper, and gold mines. Silver is almost an afterthought in these operations. This means that when mining companies make production decisions, they're not primarily thinking about silver prices. They're thinking about copper prices, zinc prices, gold prices. A copper mine doesn't shut down because silver prices are low, and it doesn't ramp up just because silver prices are high. This creates a supply inelasticity problem. Even with silver prices up 119% in 2025, you can't just flip a switch and produce more silver. New mines take 5 to 10 years to develop. Existing mines can only operate at their designed capacity. And because silver is a byproduct, increasing silver production requires increasing production of the primary metals, which depends on entirely different market dynamics. So supply is stuck. It can't respond to price signals the way it does in other commodities. This makes silver uniquely vulnerable to demand shocks. And boy, have we had demand shocks in 2025. Industrial demand for silver has absolutely exploded. Silver is not just a precious metal. It's a critical industrial material. It has the highest electrical conductivity of any element. It has the highest thermal conductivity. It's the most reflective. It's antimicrobial. These properties make it irreplaceable in modern technology. The 3 major drivers of industrial silver demand in 2025 have been solar panels, electric vehicles, and data centers. Solar panels use silver paste for the electrical contacts on photovoltaic cells. As the world pushes toward renewable energy, solar installation has skyrocketed. Every solar panel requires about 20 grams of silver, roughly 2/3 of an ounce. With global solar capacity additions running at record highs, this sector alone is consuming hundreds of millions of ounces annually. Electric vehicles use significantly more silver than internal combustion engine vehicles, up to 50 grams per vehicle in some models. With EV adoption accelerating globally, this is another major demand driver. While EV growth in the US may face headwinds under certain policy scenarios, global EV adoption continues to surge, particularly in China and Europe. Data centers and the AI boom have created unprecedented demand for electronic components, all of which use silver. Silver is in the switches, contacts, and circuit boards that make modern computing possible. As AI infrastructure expands, requiring massive server farms and computing power, silver consumption in this sector has gone exponential. Then there's the investment demand. Silver ETFs have seen robust inflows throughout 2025. As of early December, known global silver ETF holdings stood at 845, each 9 million ounces. That's a massive amount of physical silver that's been pulled out of the available supply and locked into investment vehicles. When institutions and retail investors are buying silver ETFs, those funds have to buy physical silver to back the shares. That metal goes into vaults and sits there. It's not available for industrial use. It's not available at your local coin shop. So you have structural supply deficits, inelastic mine production, exploding industrial demand from solar, EVs, and data centers, plus strong investment demand from ETFs and retail buyers. All of this is happening simultaneously. But there's another factor that's adding fuel to this fire: monetary policy. On December 1st, 2025, the Federal Reserve officially ended quantitative tightening. For context, quantitative tightening, or QT, was the process by which the Fed was shrinking its balance sheet. Since June 2022, the Fed had been allowing bonds to mature without reinvesting the proceeds, gradually draining liquidity from the financial system. The goal was to combat inflation by removing excess money supply. By December 2025, the Fed's balance sheet had shrunk by over $2 trillion from its peak of nearly $9 trillion during the COVID pandemic. It now sits around $6, so $5 to $6, $85 trillion. But here's what happened. The Fed looked at money market conditions and determined that bank reserves were approaching an ample level, meaning the system had just enough liquidity to function smoothly, but not much cushion. Any further reduction risked creating stress in funding markets, similar to what happened in September 2019 when the repo market seized up. So the Fed stopped the balance sheet reduction, but they didn't just stop. They started reserve management purchases. On December 11, 2025, the Federal Open Market Committee directed the New York Fed Trading Desk to increase the system open market account holdings of securities through purchases of Treasury bills and, if needed, other Treasury securities with remaining maturities of 3 years or less to maintain an ample level of reserves. Additionally, the Fed instructed the desk to roll over at auction all principal payments from the Federal Reserve's holdings of Treasury securities, and to reinvest all principal payments from the Federal Reserve's holdings of agency securities into Treasury bills. Now, the Fed is very careful about terminology. They're not calling this quantitative easing because quantitative easing has a specific meaning: large-scale purchases of long-term securities designed to lower long-term interest rates and stimulate the economy. Reserve management purchases, they say, are different. They're just buying short-term Treasury bills to maintain adequate reserves in the banking system. It's technical in nature, not policy. But here's the reality. The Federal Reserve is expanding its balance sheet again. It's creating new bank reserves, new money, to purchase government securities. Whether you call it QE or RMP or balance sheet expansion or liquidity injection, the effect is the same. More dollars are being created. And when more dollars are being created, each dollar becomes worth less. The purchasing power of cash declines. Investors and institutions start looking for stores of value, hard assets that can't be printed, like silver. This is why precious metals have surged in 2025. Gold has hit multiple record highs, trading above $4,300 per ounce. Silver has more than doubled. These moves aren't happening in a vacuum. They're happening because the monetary base is expanding again after a brief period of contraction. Here's another critical development that almost nobody's talking about. Silver was added to the United States list of critical minerals. In 2025, the U.S. government officially designated silver as a critical mineral. This puts it in the same category as lithium, cobalt, rare earth elements, and other materials deemed essential for national security and economic prosperity. What does this designation mean? It means that Hess government has acknowledged that silver is strategically important, that domestic supply is insufficient, that the country is vulnerable to supply disruptions. This designation opens the door to several policy tools. It allows for potential stockpiling programs. It enables trade measures, including possible tariffs or restrictions under Section 232 of the Trade Expansion Act, which allows tariffs on imports that threaten national security. It prioritizes domestic mining projects that produce critical minerals. Even if none of these policies are immediately implemented, the designation itself sends a signal to markets. Silver is not just a shiny metal. It's a strategic resource. And when governments start treating something as a strategic resource, prices tend to go up. There's another indicator that's flashing red for the silver market, and most people don't even know to look for it: silver lease rates. In the wholesale silver market in London, which is where most institutional silver trading occurs, there's something called the silver lease rate. This is the interest rate charged for borrowing physical silver. Throughout 2025, silver lease rates have been climbing. Higher lease rates indicate that physical silver is becoming harder to borrow. Market participants who need to deliver silver are finding it more expensive and more difficult to obtain. When lease rates rise alongside rising prices, it's a signal of genuine delivery stress. It's not just speculation pushing prices up, it's actual physical tightness in the market. This is very different from what you see in most commodity markets. In a normal market with adequate supply, lease rates stay low because there's plenty of material available to lend. Rising lease rates indicate that holders of physical silver are reluctant to lend it out, either because they're worried they won't get it back, or because they believe the metal is more valuable in their possession than the interest they'd earn from lending it. This is the fingerprint of a physical squeeze. Let me paint you a picture of what's actually happening in the silver market right now. There are essentially two markets operating simultaneously, the paper market and the physical market. In the paper market, traders at investment banks and hedge funds are buying and selling futures contracts on COMEX. These are sophisticated players using leverage, executing algorithmic trades, managing their positions based on technical analysis and macroeconomic data. This is where the spot price you see quoted comes from. It's a financial market. It's liquid. It's electronic. It operates 23 hours a day. In the physical market, industrial users need actual silver for their manufacturing processes. Solar panel manufacturers need silver paste. Electronics companies need silver contacts. Jewelry makers need silver. These buyers can't settle in cash. They need the actual metal delivered to their facilities. As long as there's adequate physical silver flowing through the system, these two markets stay roughly aligned. The paper price reflects the physical price, give or take a small premium for delivery and fabrication. But when physical supply gets tight, the markets decouple. Paper contracts can be settled in cash, so the paper price stays relatively stable. But physical buyers, who must have the actual metal, start bidding up prices. Premiums explode, delivery times extend, products go out of stock. This is where we are right now. The paper market says silver is 64 ounces. The physical market says silver is 70 ounces, if you can even find it. Here's why this matters. The paper market is massive compared to the physical market. The notional value of silver futures contracts outstanding on COMEX dwarfs the value of actual physical silver that changes hands annually. This allows the paper market to set the price, even though very little physical metal actually trades at that price. But at some point, the divergence becomes unsustainable. At some point, the physical market reasserts itself. Buyers who actually need silver for industrial use or investment won't accept being told the price is $64 when they can't buy it for less than $70. And that's when you get a price reset. Let me tell you what happens in a precious metal squeeze, because we've seen this movie before. In 1980, the Hunt brothers, two wealthy Texas oil heirs, tried to corner the silver market. They accumulated massive physical silver holdings and silver futures contracts. At the peak, they controlled approximately 1/3 of the entire world's deliverable silver supply, excluding government stocks. Their buying pushed silver from around $6 per ounce in early 1979 to a peak of $49, $45 per ounce in January 1980. It was one of the most spectacular price spikes in commodity history. But here's what happened. The exchanges changed the rules. COMEX instituted Silver Rule 7, which sharply restricted the purchase of silver futures contracts on margin and required liquidation-only trading. You could sell, but you couldn't buy. This destroyed the Hunt brothers' ability to maintain their positions. They faced massive margin calls. They couldn't meet them. Silver crashed back down. The lesson from that episode is clear. When a physical squeeze threatens the functioning of the futures market, the exchanges will intervene. They'll change the rules. They'll halt trading. They'll raise margin requirements. They'll do whatever is necessary to protect the integrity of the paper market, even if it means preventing price discovery. That's the kill switch. In 2025, we're seeing warning signs that we're approaching that kind of scenario again. Analysts are warning about the activation of emergency measures or limit down halts to protect the exchange. These are mechanisms that can be triggered when price moves become too extreme, when volatility exceeds certain thresholds, or when the exchange determines that orderly trading is at risk. The silver market has a long history of such interventions. After the Hunt brothers episode, the exchanges implemented position limits, caps on how much silver any single entity can control, specifically to prevent future squeezes. But position limits don't stop a fundamental supply-demand imbalance. They just prevent any individual player from exploiting it. And what we're seeing in 2025 isn't a Hunt brothers scenario where one or two speculators are trying to corner the market. This is a structural shortage driven by legitimate industrial demand, investment demand, and inadequate supply. You can't solve that with position limits or trading halts, but exchanges can try to suppress price discovery in the short term. They can make it harder for the physical market to assert itself, and that's exactly what you should watch for in the coming months. Here's what you need to understand about the current situation. Every day that the paper price stays disconnected from the physical price, pressure builds in the system. Physical silver is flowing out of warehouses. COMEX inventories have been declining, available supply is shrinking while demand remains robust. At some point, one of three things happens. Option 1, the paper price catches up to the physical price. Spot silver jumps from $64 to $70, $75, $80+ to reflect actual market clearing prices. This would validate the physical market and bankrupt a lot of short positions on COMEX. Option 2, physical premiums collapse back toward normal levels. Somehow, supply increases dramatically or demand drops, allowing dealers to offer silver closer to spot price again. Given the structural factors we've discussed, inelastic supply, robust industrial demand, supply deficits, this seems unlikely in the near term. Option 3, the exchanges intervene to suppress price discovery. Trading limits are imposed, margin requirements are raised, cash settlement is forced. The paper market is protected at the expense of the physical market. This prevents the price spike but does nothing to solve the underlying shortage. History suggests option 3 is most likely in the short term, followed eventually by option 1 as the physical shortage becomes impossible to ignore. But here's the thing. If you own physical silver, actual metal in your possession, none of these interventions can take that away from you. The exchange can halt trading in futures contracts. They can change margin requirements. They can force cash settlement, but they can't confiscate the metal you're holding. This is why the premium for physical silver matters. That premium is telling you something. It's telling you that the people who actually need silver, who can't settle for a paper promise, are willing to pay 10%, 20%, even 30% over spot to secure physical metal. Let's talk about what's likely to happen next, because the trend lines are all pointing in the same direction. First, industrial demand is not going to decrease. Solar installations are accelerating globally. EV production is growing. Data center expansion for AI continues. None of these trends are reversing. If anything, they're intensifying. Silver consumption from industrial users is going to remain at elevated levels or increase. Second, mine supply is not going to increase significantly. As I explained earlier, silver is primarily a byproduct of other mining. New mines take years to develop. Existing mines are operating at or near capacity. Even with silver prices up 119%, you're not going to see a flood of new supply in 2026 or 2027. Supply is essentially fixed in the short to medium term. Third, investment demand is likely to increase as more investors wake up to the supply-demand imbalance. Right now, silver is still relatively unknown to mainstream investors. Most people who own stocks or bonds have never considered owning physical precious metals. But as news of silver's performance spreads, as more content creators discuss the supply situation, as premiums remain elevated, more capital will flow into the space. ETF inflows will continue. Retail buying will accelerate. Fourth, monetary policy is tilted toward inflation. The Fed has stopped balance sheet reduction and started reserve management purchases. While they're being careful with terminology, the net effect is balance sheet expansion and liquidity injection. This is dollar negative, precious metals positive. Fifth, the critical minerals designation creates a policy backdrop that supports higher prices. Government stockpiling programs, mining incentives, or trade measures could all materially impact supply and demand. When you put all these factors together, the path of least resistance for silver prices is higher, significantly higher. Now, I want to be very clear about something. I'm not telling you to go mortgage your house and buy silver. I'm not giving you financial advice. What I am telling you is that there is a fundamental disconnect between what the market is saying and what's actually available. If you've been thinking about buying physical silver, you need to understand that the price on your screen is not the price you'll pay. The real price is spot plus premium. And that premium has been running anywhere from 10% to 27% depending on the product. More importantly, you need to understand that availability matters. It doesn't matter if silver is $64 on your screen if you can't actually buy it. And right now, many products are either out of stock or on extended back order. Here's what I suggest you do. Go to 3 or 4 major bullion dealer websites. Actually try to add products to your cart. Look at the premiums, look at the availability, look at the delivery times. See for yourself whether you can actually buy silver at or near spot price. I think you'll find that you cannot. And that tells you everything you need to know about the real state of the silver market. The number on your screen, 63.94, is a fiction. It's a number that exists in the paper market, where traders are betting on price movements without ever touching actual metal. It's a number that's kept artificially low by a system that has hundreds of paper claims on every ounce of physical silver. The real number, the number that matters if you actually want to own silver, is 10%, 20%, even 30% higher. And that number is rising. This is the $63 lie. And the longer it persists, the more violent the eventual correction will be when the physical market finally overwhelms the paper market. I'm not predicting when that happens. I'm just telling you that the fundamentals are all pointing in the same direction. Supply deficits, industrial demand, investment demand, monetary expansion, critical minerals designation, rising lease rates, falling inventories, extended delivery times, exploding premiums. These are not the signs of a healthy, balanced market. These are the signs of a market under severe stress. And markets under stress eventually break. When silver breaks, it's not going to be a slow, steady climb. It's going to be a moonshot. It's going to be a day when you wake up and silver is up $10, $15, $20 in a single session. It's going to be a day when dealers stop selling completely because they don't know what the price should be. It's going to be a day when premiums don't matter anymore because there's no metal available at any price. And on that day, everyone who thought they could buy silver whenever they want at the spot price is going to learn a very expensive lesson. The spot price is a lie. It's a number on a screen that has almost nothing to do with the physical reality of the silver market. The truth is in the premiums. The truth is in the delivery times. The truth is in the out-of-stock notices on dealer websites. If you want to know the real price of silver, go try to buy some, not futures contracts, not ETF shares, actual physical silver that you can hold in your hand. That's the real price, and it's a lot higher than $63.